Now, what we're going to do is go into the payout period, stage 2. So what's happened here? Well, we paid our premium in, it's grown, and what happens? Now we're 65. We made it. We're retired. So we're going to have a big retirement party, and we've got $100,000 in the annuity, and now what we're going to do is we're going to annuitize. So before we get there, let me kind of move this stuff over here so we have room to talk about annuitizing. Now, when you annuitize, as I said, it's contractual. So I'll just move our little account over here, and we've made it to $100,000. And when we annuitize or go into stage 2, as I said, this is contractual in nature. Once you go into stage 2, you can't go back into stage 1. And remember, you can annuitize, you can go into stage 2 anytime you want. That's completely up to you. There is no 10% penalty that applies if you annuitize under 59.5. That 10% penalty applied if you were in stage 1 and you were withdrawing interest prior to age 59.5. What we're doing here is spreading the money out over our lifespan. So if we're going to spread the money out over our lifespan, the 10% penalty does not apply. So we could annuitize at, say, age 45. No 10% penalty. However, the money's being spread over a longer period of time. That means we're going to receive lower monthly payments. Okay, so back to my example here. We hit age 65. We annuitize. So basically when we annuitize, we say to the insurance company, here's our money. Here's my $100,000. I want you to pay this $100,000 out to me for however long I want it, depending on the payout option I select. So I meet the insurance company, go over all this stuff, and sign off on the contract. Okay, and once I do this, there's no going back. And also, I can no longer contribute money into the annuity. I'm in the payout. So no more money is going into the annuity. So here's essentially what we do. We have this little valve here. You turn this handle, and out from the account, the insurance company is going to send us a check every month for however long as determined in our payout period. Okay, so when we go into stage 2, we have to select from the different payout options how we want to take our money for the rest of our life. Well, we annuitize at age 65. We'll say that the insurance company determines that our lifespan will be until age 85. Okay, so they, based on all their statistics and actuarial tables, they determine that we're going to have a lifespan of 20 years. Okay, so we have the first payout option we have to choose from, which is called pure or straight life income. If we select this, no beneficiary. No beneficiary. So this payout option has the highest risk for sure because there's no beneficiary. And in return for that, though, I'm going to receive the highest monthly payment from the insurance company. So here we have a risk-reward trade-off here. Depending on how risky I'm willing to be with my money in that annuity account, the insurance company might be willing to pay me a higher monthly payment per month. Here's how this would work. If I select the pure or straight life income payout, the insurance company will pay me every month a certain dollar amount until I die, regardless of how long I live. So I set up here 85. They figure that my lifespan will be 85. What this means is, regardless of which of these payout options I select, the insurance company will guarantee that if I live to be 85, I will have received at least all of my money. Okay, so I'm really spreading my money out over my lifespan. However, what if I live longer than the average? What's the insurance company going to keep having to do? They're going to have to keep paying me the dollar amount that was agreed upon when I annuitized. So you see, my dollar amount payment is going to be based on a number of things. It's going to be based on the payout option I select, obviously, is going to be a big determinant. How old I am, because the shorter my lifespan, the higher my monthly payment. And also a big one's going to be the amount of money that I have in my account. Now, assuming this is a fixed payout option, what I mean by that is fixed versus variable. If it's a fixed payout option, the dollar amount they determine when I annuitize will never change. It will be the exact same amount for the life of the policy payout. So we'll say that they will pay me, $1,000, just making up the dollar amount here. If I select this option, well, that means I will receive $1,000 every year for the rest of my life. Well, what if I live to be 125? What happens then? I've won, haven't I? Because I said here, they guarantee if I live to 85, I will have received all the money I invested. Meaning that my account here has gone dry. Well, they still have to pay me, don't they? Okay, so I've won. So remember earlier I said, depending on the payout option you select, the insurance company wants you to die. Here they do, because look at this. What if I die when I'm 66? What happens to the rest of the money in my account? If I pick this payout option, the insurance company keeps it. Major risk-reward trade-off here. Okay, that's one of the various types of payout options I could select in my annuity. Okay, well maybe I don't want to be that risky, so I have the second one to choose from, which is called life income with period certain. How does this work? Well, this one I have a beneficiary, only though for the period certain, which generally is a certain number of years that I select when I annuitize. So the payments here are going to be less. So maybe $3 signs. Maybe they'll pay me $8.50 a month if I select this payout option. And we'll give an example here. We'll say I select a life income with 10-year period certain. What does that mean? Well, that means up here, remember, they determine my lifespan to be 20 years. If I select life income with 10-year period certain, I'm guaranteeing the first 10 years of payments, starting when I annuitize. And if I die anytime during those 10 years, the payment I was receiving will continue to my beneficiary until the end of those first 10 years. So, say I annuitize, select life income with 10-year period when I'm 65. I die when I'm 70. What's going to happen? My beneficiary will continue to receive $850 for the next 5 years. Because the 10-year period certain ends when I'm 75. How about this though? What if I live to be age 125 and I had selected this payout option? The insurance company will have to pay me $850 every month from when I annuitize at 65 until I die at 125. Okay? So just so that's clear, regardless of which type of these one or two that I select, I get paid for the rest of my life as the annuitant. Okay, so we have number 2. Let's take a look at number 3, which is called a refund. Refund life annuity is the safest. So I'll put $1 sign there. Lowest monthly payment if we select this lifetime payout option here. Refund life. I die anytime before receiving all my money, or anytime before age 85 in my example, and I'm just making all these numbers up in time frames. I die anytime before getting all my money back at age 85. The remainder is refunded to the beneficiary. Well, how about this though? What if I live to be 86 and die, and I selected a refund life annuity? Will the beneficiary receive any money? No. Why? It's all gone. Remember, it's gone at age 85 in my example here. So that's a refund life annuity. Safest option because I'm guaranteeing all my money, but always remember, regardless of which of these first 3 options I select, I get paid for the remainder of my life. Okay? So those are the first 3 payout options. Now we have a couple more that we'll talk about, and they're really different than these. So these first 3, we get paid, the annuitant gets paid over the span of his life forever. Now there's a couple different settlement options, a few more that we can select from. Okay, and the first one we'll talk about, because it's similar to this, is called joint and survivor. And this is when we have more than one annuitant. So a lot of times you see this utilized when you have a husband and wife as co-annuitants. So we have the husband and the wife. Now, joint and survivor annuity payout option will pay out until the surviving annuitant dies. So they annuitize, and they're receiving $750 a month. Husband dies. Benefits continue on to the wife. Depending on how it's structured at the insurance company, the benefits might be reduced a little, maybe in half or maybe 3/4 of that amount, or possibly the full amount. But they will continue on until the surviving annuitant dies, and then they stop. So really it pays, a joint survivor payout option pays out over the lifespan of 2 annuitants. Okay, so we've got that, and usually that's a lower payout because they're paying out for a longer period of time than just if one person died. Okay, and we've got two last payout options, and they don't really have anything to do with our lifespan. Okay, so we can forget all about our lifespan. These two ones are very easy. Okay, so we've got number one here, payout option is fixed period. If I select a fixed period payout, I say to the insurance company, I've got $100,000 in my annuity here. I'm whatever age 50 maybe. I say, I want you to pay that money out to me per month over 10 years, and then I want it gone. That's a fixed period payout option. Obviously, it doesn't pay out for the remainder of my life. It only pays out for a fixed period, as determined when I annuitize. Now, another option, remember, neither one of these pay out over my lifespan. They pay out either for a fixed period or they will pay out a fixed amount. So if I tell the insurance company, I annuitize, and I say I want them to send me $3,000 per month out of my annuity, that's a fixed amount payout settlement option. So this is my choice, and at some point in the future, most likely, the account balance will run dry, although we're unsure of when that's specifically going to occur. Now the last thing, those are all the payout options you need to know for the exam. The last thing we'll talk about is taxes during the payout. Now here's really what you need to know. When you select your settlement option, depending on the amount of your cost basis, which is the amount of money you paid into the annuity, the insurance company is going to spread that amount over your payout. So, for example, say we selected a fixed period of 20 years that we wanted it paid out when we are age 50. Okay, so it's going to pay out until we are 70 years old. And we'll say that we've invested $40,000 is our cost basis in the account. That's what we invested in the annuity. What they're going to do is they're going to take our cost basis and spread it out each year over our lifespan. So we'll say each year that we will receive from our cost basis $2,000. So here's really how it works for taxes. Because remember, when you go into the payout period, there's still interest accruing on the money, and the insurance company still has to accrue the interest in the account, and it gets paid out to you over your payout period, and that is taxable to you, because remember, it was tax deferred until you received it. But here's how they do it on the payout. They spread out your cost basis over your lifespan, because remember, when you enter your payout, you can never add more money into the annuity. So this dollar amount, your cost basis, will never change. The amount of interest, though, is going to change because it continues to accrue. So since this never changes, this is what they use to determine how much you have to pay in taxes. They spread this out over your lifespan. So assuming we have a 20-year lifespan, or that we wanted it paid out over 20 years here, well, basically what the insurance company is going to do is divide the $40,000 by the 20 years and come up with $2,000. Okay? $2,000 per year. The first $2,000 you receive are coming from your cost basis. Any amount you receive over and above that per year is going to be taxable as the interest, as ordinary income, at the ordinary income tax rates. Okay, now remember though earlier we talked about, well, you could actually profit from the annuity and the payout. You could get more than you paid in. Well, if you do, if you hit zero here and they've paid out all your cost basis and they still have to pay you with those life income payout options, it's 100% taxable. So once you've received all your cost basis paid out of the annuity, they still have to pay you if you selected a life income payout option, such as pure straight life income, a 10-year period certain, or period certain, or refund annuity. They have to pay you as long as you live. But once you receive all of your cost basis, they still have to pay you, and it's 100% taxable as ordinary income. But you're probably going to be in the lower income tax rate. Okay, so that's the basic explanation of the various things related to the annuities. Now, there's a couple things that we'll talk about, and it relates to the different types of annuity products. Okay, so we have fixed, and then we have variable. And here are the big differences. Fixed annuities have guarantees. Variables have no guarantees. So which one's going to be riskier? Fixed or variable? Variable, because there's no guarantees. Your money that you pay in is directly invested in the stock market. You could lose all of it at any time. Now, why would somebody invest in a variable? Because they're looking to keep pace with inflation. So fixed products have inflation risk. Now, inflation risk is also referred to as purchasing power risk. Well, if you invest in a variable, a lot of times the money's being invested in mutual funds, usually stock mutual funds, where they're trying to keep pace with inflation. And historically, since its inception, the stock market has done a pretty good job of keeping pace with inflation. Well, if you buy a fixed annuity and they're paying you a fixed guaranteed rate of return, such as 4%, well, what about in 20 years? That 4%, which you're still receiving, over here in a variable, you might be receiving 20%, okay? So depending upon the rate of return, the market, and all that stuff, it's inflation risk with the fixed annuity. Fixed annuities have big inflation risk, especially if you select a fixed payout option, where they decide to determine what you're going to receive every month, and that's what you're going to receive for the life of the policy. Well, if you select a variable payout option, you will know exactly what the first month's payment will be, but thereafter it'll go up, it'll go down, based on the performance of the account, the separate account, and the variable contract. Okay, so that's a big one you had to understand. Now, there are a new type of annuity product, which is called an equity indexed annuity, which kind of blurred the lines between fixed and variable. So it's kind of almost like a hybrid annuity, where the equity indexed annuity has guaranteed minimum rates of return, but it also has current rates of return that are based on stock indexes or equity indexes. Most commonly used is going to be the Standard & Poor's 500 index. So, with an equity index annuity, which by the way is classified as a fixed annuity, meaning you only need an insurance license to sell it currently, that could change at any time, but currently equity index annuities are classified as fixed products. Equity index annuities, you have a guaranteed minimum rate of return, so they're safety, but you also generally annually get credited an excess rate of return based on the return in the Standard & Poor's 500 index, which is the most commonly used equity index. They don't have to use the S&P 500, but most equity index annuities do use the S&P 500. So if you want a current, or you're worried about inflation risk, but you're also worried about the high risk in the variable where you could lose all your money, this one's for you. Equity indexed annuity, which by definition fits under a fixed product definition. So these are really the big three types of annuities that you need to know. And another couple things I'll mention for definitions, we have these terms, annuity unit and also accumulation unit. And basically these are just accounting terms. You buy a variable annuity, when you pay your premium in the accumulation stage, you're actually purchasing accumulation units. So this is the accounting term they use in stage 1. If I was to annuitize, which I can do at any time, remember, I can annuitize and go into stage 2. They convert my accumulation units into annuity units. So this term is synonymous with stage 2, the payout period of the annuity. So I have accumulation units, annuity units. You could think of them like shares of a mutual fund. If you want to invest in a mutual fund, you cut a check to the mutual fund company. They convert that check into purchasing shares of the mutual fund. Well, same thing, you buy a variable annuity. You're purchasing accumulation units during stage 1, which essentially are shares of the mutual fund, okay? Which, when you're paying your money into annuity, generally the insurance company's using your money to buy you shares of a mutual fund and hold that money in the separate account. Well, in the annuity, though, they call them accumulation units, not shares. And then if you annuitize that variable annuity, they convert them into annuity units, okay? And the last thing we really would need to explain for you is, on the exam, you need to be careful when they ask the questions, because sometimes they ask questions about non-qualified annuities, and sometimes they ask questions about qualified annuities. We're talking about tax qualified. Now, all the examples we went over on the board, and as far as purposes for the exam with taxes, we were talking about non-qualified annuities, which most of your questions will be based on the exam. However, there are qualified annuities that they might ask about on the exam. So an example of a qualified annuity would be what's referred to as a 403B plan, or TSA. And TSA stands for Tax Sheltered Annuity. Okay, now here's the big difference. This is a qualified plan. This is a retirement plan. Only eligible individuals can establish one of these. And you see a lot of teachers that work for public schools have these TSA accounts or 403Bs. It's an annuity. And they actually contribute to the annuity from their paycheck, from their gross pay. So the money going into the annuity, this annuity, the qualified annuity, has not been taxed. So they're contributing in here, plus there's interest that accrues on top of there. And here's the trick for the exam though. In a qualified annuity, when a person takes distributions or takes the money out, it's 100% taxable. Why? Because there's no cost basis. There's no cost basis. Remember I said they're contributing to the qualified annuity with money that's never been taxed. And the definition of cost basis or basis is the amount of money we've already paid tax on that's being invested into the product. Well, that's in a non-qualified annuity. The money we pay into the non-qualified annuity, we've already paid tax on, so we have a cost basis. However, in a qualified annuity, such as a 403B plan or a TSA, it's the same thing, just two different words for it. The money going in is going in pre-tax. There is no cost basis. So when this teacher decides to take a distribution from the TSA, the qualified plan, it's 100% taxable. And there's also going to be a 10% IRS early withdrawal penalty if the money is taken out prior to 59.5 on the full amount. Okay? So that's the differences as far as taxes go. Qualified annuity, non-qualified annuity. I would assume on this exam that they're talking about a non-qualified annuity unless they specify it's qualified. And usually they probably wouldn't specify. They just say a tax-sheltered annuity, and they expect you to understand that's a qualified annuity, and the taxes are different for qualified annuities. Okay, so that's the end of our presentation there on the board of annuities. Okay, so we'll pick up there in the book on page 53. We have that little overview there on the board, and that hopefully will help clarify the concepts as they're presented here in the book. At the top of the page on 53, the first paragraph says, annuities are the opposite of life insurance. We already said that, right? It says life insurance creates an estate for your heirs when you die, while annuities are designed to liquidate an estate through a series of systematic, guaranteed, we're talking about fixed annuities here, in most cases, payment to the annuitant as long as that person lives. In the second paragraph it says, fixed annuities are a lot safer. There's minimum guaranteed rates of return. Remember, in the fixed products, the investment risk is to the insurance company, and the insurance company holds the person's money in the general account. Also, another point to make there in the second paragraph is fixed annuities are backed by the state guarantee fund. Every state has an insurance guarantee fund that protects policyholders of insolvent insurers. This means insurance companies that go broke. So if I have an annuity and say I have, $20,000 in the annuity, and the company that I bought it from goes broke, I can apply to receive that money back from the state guarantee fund up to a certain dollar amount. Now, a big key with the state guarantee fund is you cannot refer to it in a sales presentation. Your customer can ask you questions about it, but you can't directly refer to it in a sales presentation. Bottom of the page, page 53, it says immediate versus deferred annuities. We talked about the different ways you can pay in. First one they mentioned there, last paragraph, single premium annuity. Two different types, single premium immediate and single premium deferred. Remember, a single premium immediate annuity, we go directly into stage 2 and start taking the payout. Single premium deferred, we pay a lump sum in and we let the money sit in there. Now remember, the only way you can purchase a single premium annuity is with a lump sum of money. Top of page 54, it says in the second paragraph, there they are listed. Single premium annuity may be purchased to start paying you back right away, or to start paying you back at some point in the future. Then we see deferred annuities, maybe a couple questions on this for your exam. Then it gets into some tax issues. So how, if you're going to be taking money out of the annuity in the pay-in period, stage 1, how is the money taxed? Was it taxed as a return of cost basis first or a return of interest first? Answer is interest first. So they use for annuities what's referred to as last in, first out when taking distributions, taking withdrawals from the annuity. Second to last paragraph, I like the first sentence, says, remember, although annuities are life insurance, they contain no life insurance protection. And they give a little example there. Annuities may be purchased regardless of age or health. There's no underwriting because it's not a life insurance product. We have bottom of the page, last paragraph, flexible premium deferred annuities. That would be sold to a person maybe who's on commission or doesn't know exactly how much they want to put into the annuity over a period of time. They just purchase the annuity and do whatever they want from that point. Then we go to the top of page 55, stage 2, the payout stage, or annuitization as it's sometimes referred to. Says the first paragraph, top of the page, most annuities are purchased for retirement purposes. And it goes on to say, number 1, 2, and 3, these are in part what the payment you receive per month will be based on. Your expected lifespan, obviously. The longer the lifespan is, the shorter the monthly payment. Amount of money accumulated, the more in there, the more you're going to receive. And the type of payout option selected, whether it's fixed or variable. So we said fixed payout option, that's definitely going to have some inflation risk or purchasing power risk. The variable payout, it's going to fluctuate based on the return performance of the stock market. Then we have our payout options. Okay, so write some notes in here. This relates to the stuff we went over on the board there. Pure or straight life annuity. Most risky, highest monthly payment. Right above there, this pays for the life of the annuitant regardless. Okay, but there's no beneficiary. No beneficiary. So highest risk, highest reward. And then we get in the next one, life income annuity with period certain. So less risky. So lower dollar amount payout. Remember though, this payout will pay for the life of the annuitant regardless. All we're doing is specifying that we want to guarantee our payments whether we live or die for a certain period of years. This could be 5 years, 10 years, 15 years, 20 years, 25 years, depending upon how long the person's lifespan is expected to be. Longer the period certain, the lower the monthly payment because the more money we're guaranteeing whether we live or die. On the next page, page 56, top of the page, refund life annuity. Okay, refund life annuity, safest, lowest monthly payout. Regardless of when we die, if there's any money left in our annuity account, that money is just refunded. They cut a check to the beneficiary. Beneficiary obviously is going to have to pay tax on any interest they receive, but we're guaranteeing all our money. But remember, this payout again, it's a life payout, will pay as long as the annuitant lives, but lower monthly payment. So, how much risk are you willing to take? Okay, that's what it depends on there. Then we have single life versus multiple life. Remember we talked about there was a multiple life payout. We had joint and survivor annuity payout. Well, they list two separate ones here. We've got joint and survivor, which pays out over 2 lifespans. Then we've got number 2, joint life payout, which pays out over 1 lifespan. Now, between those two, joint and survivor and joint life, which one do you think would result in higher monthly payments to the annuitants? Answer is going to be number 2. Why? Because it pays until the first party dies. So we're only paying out over 1 lifespan. Less payments, higher monthly payments. Remember, joint survivor, we're paying out over 2 lifespans. Now remember also we had 2 additional payout options, which you might want to just write in there somewhere. We had fixed period payout, where we can specify to the insurance company we want them to spread out our money over a certain period of time, not forever, not until we die, but for a certain number of years. If we die before the end of those years, then the rest of that money goes to a beneficiary. We could also specify we want fixed dollar amount for them to pay us for that, and then at some point in the future, possibly that money's going to run out. Okay, so those are 2 additional payout options we have, all annuities have, that we have to select from, so you might want to write that in there somewhere. But those are pretty straightforward. Then we have the center, page 56, annuity products. Fixed annuities, variable annuities. So put us 2 stars probably by fixed annuities. Couple test questions most likely on that. So a couple things with fixed annuities: guaranteed minimum rate of return, money's held in the insurance company's general account, investment risk is to the insurance company since there is a minimum guaranteed. If we annuitize with a fixed payout, the dollar amount never changes. It's the same. So fixed annuities, remember we said have purchasing power risk, so you definitely want to make note of that. And also the fixed products are backed by the state guarantee fund. Then we go into variables. Remember, variables, no guarantees. So if you purchase a variable, though, you're looking for to reduce your purchasing power or your inflation risk. You're looking to keep pace with the rate of inflation. Money that you invest is held at the insurance company's separate account. When you purchase money, you're paying money in during the paying period on a variable annuity. It purchases you accumulation units. When you annuitize, they convert those accumulation units to annuity units. In a variable annuity, who is the investment risk to? The insurance company or the annuitant? The annuitant would be the answer because it's very risky. There's no guaranteed rate of return. You could lose all your money in a variable annuity. And also, last thing to mention with variables, in order to sell them, you have to, in addition to the insurance license, have a securities license, either a Series 6 or 7, and a Series 63 and 66, depending on the state that you're going to be selling in. Okay, not backed by the guarantee fund either. So you lose your money, you cannot recover that money back. Too risky. Now, at the top of page 57, we have the second paragraph, equity indexed annuities, which you'll probably have a couple test questions on your exam. Remember, this is kind of a hybrid type of annuity. You have a guaranteed minimum rate of return, plus you have an excess rate of return that's based on a rate of return from an equity index. So the most commonly used equity index is going to be the Standard & Poor's 500 index. It's a stock index. So we're trying to keep pace with inflation, but we have a guaranteed rate of return. So it's a safer. Now remember, equity index, they're basically right now categorized as fixed annuities, so you only need this license to sell them. Then we have uses of annuities is the next heading there. It says most deferred annuities are purchased for retirement planning, so put a star by that, like in our example that we used there. Or a child's future educational expenses, I suppose. Immediate annuities usually purchased to supplement the annuitant's pension or Social Security. Now that brings up a good point. Say we have a person, well, just say on the exam they ask, who most likely would purchase a single premium immediate annuity? Well, somebody who's 65 who has a lump sum of money and wants to spread that out over their retirement and help supplement Social Security, that's the person who's going to buy a single premium immediate annuity. Other uses says, remember, fixed annuities, guaranteed rate of return, and the insurance company bears the investment risk. Variable annuities, no guarantees. Annuitant bears the investment risk. Variable annuities usually purchased to hedge against inflation. Now notice it says in here, two sentences ahead, or next sentence. Annuities are also used in structured settlements and in business to fund such things as guaranteed sports contracts, real estate contracts, and even the lottery payouts. So put a star by there. Also remember, annuity values are measured in units. So here's that information we covered on the board, but highlight it, start in your book, which are similar to shares in a mutual fund. During the pay-in period, annuity values are measured in accumulation units. During the payout period, annuity values are measured in annuity units. Okay, so we have that. Then we have lump sum settlements. Says annuities are often used in structured settlements. Example, won a lawsuit for $1 million. Defendant's insurance company most likely ask you to accept annuity instead of cash. Course, save the insurance company money. Also allows you to structure the award. So again, they're just holding the money and they're paying it out to you systematically, lump sum. Says the last sentence in that paragraph, lottery payouts, professional sports contracts, some real estate transactions. Also utilize annuities, pay it out over a period of time. So there's our fixed period payout option, such as 10 or 20 years instead of life, rather than lump sum payment for tax reasons. Then we have our tax sheltered annuities. These are the 403B plans right above this qualified plan. Private school teachers can establish these. It's a retirement plan that they contribute right from their paycheck, from their gross income, pre-tax money. So it's funded by salary reduction, no cost basis. So when this person takes a distribution or takes money out of this plan, it's 100% taxable, all of it, because there's no cost basis. And there's a 10% IRS early withdrawal penalty if they withdraw any money prior to age 59 and a half. Let's see what else it says. Who else is eligible? Employees of public education institutions, so teachers, tax-exempt nonprofit organizations, and church organizations may exclude from their gross income, within limits, premiums paid on a contract that will provide for an annuity upon retirement. Employees of for-profit, highlight this, private schools are not eligible, nor are students. Next paragraph, generally TSA is considered to be tax-qualified plans in that contributions are excluded from the participant's income and earnings accumulate on tax-deferred basis. Since neither the contributions nor the earnings have ever been taxed, all distributions from TSAs are taxable as ordinary income, and 10% IRS early withdrawal penalties may apply if a participant is under age 59 and a half. And that's going to be end of the annuity section. And go ahead, print off the next section, which is going to be taxes. Read through that, and that'll kind of be a review. I've tried to incorporate these tax issues as we've kind of gone along throughout the material here. So read that, and then we'll do that, and then we've basically got 2 sections left, taxes and qualified plans. We'll get those done, and we'll be finished with life insurance. Okay, so I'll see you in the next section.